All right, there we go. We are recording, and it's May 16th. We were just talking about how time flies. Brian and I were. May 16, 2024. This is the Edge Live demo and discussion. Thank you for joining. I'm Tim Quast. Along with me is Brian Wilson, market strategist, and we will tag team this. As you now know, I'm going to go first, and then Brian will take us across the finish line. Okay, so let's see. There are just two things that I would. Steve, you got your hand up. Yes, please. What you got?
Yeah, since you're talking about recordings, where do we find these recordings?
They are principally on our YouTube channel. Isn't that right, Brian?
I went there.
Yes.
You didn't find them?
Not
let's
last
see.
week. The first one I see is 2 weeks ago.
Let me ask.
Yeah, we'll check with Henry and see how often they get updated.
Henry's
and then
kind of the point person on those because he's the youngest of us. You know, Brian and I, we're too old for social media. We don't know what we're doing.
the other thing that I want to bring up, if you're using the data recommendations, the daily recommendations,
yes,
is watch out for wash sales.
Oh, interesting.
Because I just got hit by that.
Did you?
I bought back into Kroger after having a loss of 1% and then just made money off of it and realized I'm getting hit for the wash sale. So just a heads up.
Yep. Very good. So one might want to be very careful about coming back into the same security. And I've done that too. Yeah.
Within 30 days.
Yeah. Okay. Yeah. It's a very, very good point. Yeah. We may have to make a note about that. You know, it's a good reminder. It has gone through my mind a couple of times, and I haven't experienced any consequences. But thanks for the heads up.
That's the benefit of trading in a 401k.
Well, exactly. Yeah, that's what I'm doing too. That's
self-directed 401ks is a license to steal with both options and stocks.
Maybe it just speaks to the poor design of the 401k. There's that one could make that argument too. But anyway, thank you, Steve. Appreciate that. Let's see. So I've got three things that I'm going to cover, and I think Brian's got three or four. I will. So in Kara, I think it was you. I don't know if it was Kara or if it was Carla or someone else, and I'm not mixing it up. But somebody asked me a question right at the end of the last demo, and sometimes I see those, but after the meeting has ended. And so, and Kara, if it was you, I just want to answer your question. You asked, or whoever it was asked, do I enter these positions at the absolute low entry point or somewhere in between? And do I put the orders in pre-market or after the market opens? And I have, what I've been doing is I'm generally going to be biased toward the low end of the entry range, and it might be the full entry range, particularly depending on where broad supply and demand are. If broad sentiment has peaked, I'm going to be at the low end of the entry range. If it hasn't, I may not. I might be, somewhere in there. Because stocks, when there's a lot of momentum, and how are you going to know there are a lot of choices in the two portfolios? Then these things are probably going to move, and I might take even zero if it's unchanged from the day before. I might just buy it there. And it's not an absolute science. It's a judgment call that I make based on demand and supply. But I am putting these in. I have come, much to my own surprise, to appreciate pre-market limit orders. They have been working very well. So you put them in, you let the price come to you, and you're probably going to do fine. It's probably going to work out. It's been a great month for me, and I know it has been for you too, Steve Hicks. But that's what I'm doing, Kara. I'm putting them in pre-market, and the ones that fill become the positions. So let's say I'm the average in the portfolio. That's why we have a real surfeit right now. And at some point, it's been cut by a third just in the last day or two. The average is 7. So if we have 15 or 20, that, it's kind of an amazing number. Okay, thanks, Kara. I think it must have been Carla then. I trade notes with Carla, so it must have been Carla. Sometimes I can't remember another sign of age. Was it an email? Was it in the chain? Was it in the demo? Was it in a webinar? Because there's a lot of communication. But back to the point, so maybe I put in 4 or 5 limit orders pre-market, and 3 or 4 of them fill. And if something doesn't, I don't care. I don't care, right? Just make it for the day, because then it even takes care of itself. Instead of good to cancel, which I'll use oftentimes, if it's a limit order or stop for the day, then you can check them again the next day. But it becomes very automated, and it's just been working great. I've had a little DJT that was up more than 2%, and it filled at exactly 9:31 Eastern time against my stop, and my stop was up 2.3%. So because I moved it up overnight, I moved it up. I saw that, well, it's there, I might as well. And I'm very happy with that. So with that, let me get into the core things that I want to talk about, because that is actually part of it. And again, the 2 rules are: please mute yourself while we're having these discussions so there's less background noise, and then ask questions. You can interrupt me. I don't mind at all, because sometimes I won't see it. So just jump in if you have a comment, question, observation.
Yeah, Tim, quick question from Cara. With the orders pre-open that don't get filled, do you leave those throughout the day, or do you cancel them at a certain time?
If they're good for the day, they're going to cancel themselves. If I want to redeploy that capital, I might go back. And I don't have an exact approach to that. If I've got time and I'm looking, I may cancel the trade and use that capital. If something else has given me an entry point, I'll take it. But I don't overthink it, Kara. I just what I'm trying to do as much as possible is let the machines do the work and not have any stress over it. That's what we're after. You want as much of a stress-free, take your small gains experience as possible. And I do think it's very important to be happy with your 1 or 2%. You think, oh man, it went up another 3%. Who cares? It might as well gone down 3%. So, that's just the luck of the law of the jungle. But if you take those little gains, it's just the best way to go. You have a low limit. So are you entering an order for all stocks that are 50% and above? Or, I don't even care. Frankly, I look at the choices that I'm happiest with, and I put an order in, and I don't even really care where it is pre-market. And if it comes to, what I'm finding is half the time they come to me within the first hour and a half of trading. And this happened with DJT. I'm not condoning or in any fashion saying DJT is a good thing to trade. I just looked at the supply demand balance and went, that thing's going to give us some returns, right? And it was way above my entry point. But by 10 o'clock Mountain Time, as I was driving along someplace, that order filled. And I filled it at, I think, like 51.92, something like that, or 51.89. And I sold it at 53.03. And you could do the math on that. It's a little better than 2%. That's what I do too. I'm just calculating what is my entry point, putting my stop in about 1% below that, and calculating a 2% return and being very happy with that. And just letting the machines execute those trades. What I did overnight is I looked at it and said, well, I can even move my stop up from being 1% below my entry point to well above. I could put my stop was 2% above my entry point. So then I was guaranteed to make my 2% return on that stock. And if it hit my stop, that was fine, and it did. So I'm finding that works very well. It is so far the least. And there are different things that we try. I don't know everything about this, but we're certainly learning that this approach works pretty well. We know what the math is. The question then is, how do we as human beings make the best use of it? So that was core to me. The mechanics are so long as we have, let me share my desktop and I'll just walk you really quickly through this. And any, anybody has comments or observations about this, please feel free to jump in because you all are using these approaches too. So what I do, and I actually, I log into my Interactive Brokers account and I'm just going to look at my entries and exits. I like lower priced ones. I mean, it's going to default to volatility. So you can even do that, right? It's, yeah, and interrupt if you got an observation. So volatility is the default sort. It's going to give you the most at the top end. Sometimes I just like lower entry prices, because I know as I've mentioned before. So this is the benefit for the benefit of somebody who may not have heard that. When the SEC studies how it might redefine spreads at round lots, it looks at stocks between $20 and $50. The SEC thinks mechanically, and where are they getting that? From the high frequency traders. They're getting that from Citadel and Jane Street and Hudson River Trading and Two Sigma and Quant Lab and Infinium and Tower Research and firms like that who are responsible for over 50% of the volume. And they're the ones that the market depends on for low spreads and general stability. Do I like that? No, they're proprietary traders. They have the highest margins and they're the ones that everybody depends on for prices. Okay, but the point is, from $20 to $50, we know is kind of the sweet spot for those machines. Well, then I might look at that. I was trading emails with an edge user this morning who said, "Well, I'm only buying the 100% probabilities. Why would you pick something that isn't 100% probable instead?" And I said, "Well, it's just a central tendency. I mean, what I find is anything better than a coin flip is a good probability. It's got to be better than 50%, and everything in here is going to be. And remember, this is just what happened before. So in some sense, if something is 100% probable, there is a mounting probability that it will become less than 100% probable, right? That's the problem. I am finding no statistical difference between something with a 2/3 probability and something with a 3/3 probability. So, just keep that in mind. They're all central tendencies. All of these are of a kind that are likely to give you a return. And so then what mechanically I do is I look at the entry price. I'm going to look at the broad market sentiment. You can click through one of these and do it that way too. If I click through, I can't even, what's PAAS? I wish we should have the name on the mouse over, and it's in our development tracking system that we use in Azure. So PAAS, if I click through, I can go look at broad sentiment. And if it's really good right now, except that we're hitting options expirations today and tomorrow. New ones trade Monday. Banks will try to square the books Tuesday. And VIX expirations are Wednesday. And we're trading at the lowest. VIX is at the lowest of the year. Low volatility is not a good sign. Low volatility precedes trouble. You have to have volatility for a market to function well. Right? It's very important to know. Don't buy into this idea that the absence of volatility is a good thing. It means that the spread between the basket of stocks and the ETFs that the market makers are using to try to create prices and produce returns. Jane Street is killing it in that market, is the #1 trader of ETFs. And it has 70% margins. They mint money. And you know why. We've explained this before. If SPY moves 1% and the basket moves 2%, they have a theoretical 100% probability of a 100% return just by being long and short. It's just going to work out. And why is that permissible? Because they create all of that quote unquote liquidity. If we put in a market order, it's going to get filled. I can put in, thousands of shares of lift and fill a trade. And why is that? Because somebody like Jane Street is in there saying, well, I can make 1/10 of a penny. I'll move the price and somebody will take it, and I will make my 1/10 of a penny per share. So I'll take the other side of that trade with a little price improvement. That's what's really going on. So you want to know those things, beforehand. That's all important to know. That when I look at this supply demand balance, if I'm going to in options, I didn't buy anything else today. Because I'm just taking a particularly cautious approach here because I got my hands full. I'm trying to catch up from this trip, and I've got a to-do stack as high as my waist. So I'm just going to be careful. I don't know I look at the supply demand balance. I think it's very good, and it's likely to do just fine. But my losses have come only in 2 situations, and that is trading things during earnings and trading things during options expirations. So if I want an absolute assurance of avoiding losses, I avoid both those things. Okay, so the mechanics, that's what I'm doing. Every day I'm going to look at the list. I might, it's a judgment call on whether I take lower price things or whatever's there, and I set up some limit orders, and what fills. And and then I set brackets around them. You can do it. I'm sure you can do that on any platform. On Interactive Brokers, if I put a limit order in, I can put a bracket on it, and I'm going to put it up 2% from my entry price, and about 1% below it, and set and forget. Good for the day. Those things will cancel out at the end of the day. If I think I'm in a good period, maybe it's good to cancel, so it can run for several days. I did that with Lyft. And I'll talk about the Lyft with my point number 2 here. That's mechanically what I'm doing. Quick look at Lyft. So here's what I want to tell you about, what happens if you're using the daily trading ideas and you bought Lyft and then you go look the next day and it's not in there. Well, it's a great reason to use the Edge platform, because if either side of the equation changes, just leave it. I mean, if you haven't gotten your 2% return, and that's going to happen periodically. You're sitting in a position that you bought from the daily trading ideas, and you haven't gotten a 1% return or 2%, one of the two. Low volatility is 1%, momentum is 2%. And then the stock isn't in the daily trading ideas, and you just look it up and you can see why. So Lyft has falling demand and rising supply. Well, just leave it and redeploy that capital, right? It's telling you that you should. You may have 5 days, but just move on. Why take the chance? That's a great reason that no one else is going to know to leave. Right? And go find something else with a better probability. Converging supply and demand tends to lead to falling prices. I made it was awesome. I got stopped out at like 17.59 yesterday in Lyft. So I had a very nice margin, but I had to be patient. I had to wait, a couple of days. It didn't do anything. Just sat there. And sometimes that, it's not a guarantee that something's going to move 4% every day. That is the average, right? That's just taking a rolling average that it moves 4%. Some days it might not move at all, and then it moves. And you'll get the benefit because of the supply demand imbalance. The probability, all other things being equal, that you will get a good intraday move when there is a strong supply demand imbalance is very, very mathematically high. And that's what you're counting on. You just let the math do it. And I was somewhere between Austin and Amarillo when that thing filled, driving with Karen and Clyde the hound dog. He's too big to fly, so we have to drive if we're going down to see family down there. Okay, so last thing that I wanted to point out is, let's see. Maybe that's good. I've kind of
Hey, Tim,
blended.
couple quick questions for you.
Yeah.
One from Joe. How are you putting in stop orders after hours?
So I just put in and I'm not using them generally outside regular trading hours. I can choose that. I can toggle that at Interactive Brokers where I can trade outside of regular trading hours. Very difficult to fill. Actually, my DJT position filled right before the market opened this morning, which was a little head scratching because I didn't actually specify that. That's fine. I didn't care. But outside market hours, I don't care what the price is doing. I'm depending on the entry price. Mathematically, it's pretty good. So I just put in, let's go, I'll give you a quick example, and then Brian, I've covered my three things. I kind of blended them. But and we can both tag team what's ahead. The other thing was volatility and the broadening of the rally. The low volatility, good thing? No, it means we're running out of arbitrage opportunity, which is essential for supporting prices. It means something's going to have to give. And then the talking heads were saying, well, the market rally is really broadening. It's not just concentrated in a handful of stocks, it's spreading out. That is not the beginning of better things. That is what happens when what's in the basket is the big stuff coming out. That's when you hunt around for other stuff that is substantially similar. It's a poor understanding of how the market works to suggest that a broadening rally is a bullish signal, not in a market dominated by ETFs. That might be true if the only thing driving the market were simply the allocation of capital to equities. You could say, well, then everything's, that people are putting more money to work and that's leading to a broadening rally. No, it's not the way that the market works. You have to track and benchmark. There are things that do and most things that don't. So when the money starts to spread to stuff that doesn't track the benchmark very well, it tends to be at the end, not at the beginning of a big rally. I'm not saying it's over, but those are important things to know. Okay, what was it again? After God, yeah, I talked myself right out of that one. The example.
Putting in a stop order after hours. Let's say that you have a position in DJT. Do you put in a stop loss order to protect yourself in case that's going down?
Yes, I do. So let's say it's DJT, and because I think we're getting near the end of the rally, so the entry low would be 50.14. So maybe I put it at 50.31. Maybe it's even a little higher, 50.71, something like that. And I tend not to use round numbers. Why? Because machines don't. Machines don't submit round lots. Machines don't do blocks. Machines trade amounts of money. That's what they do. And so most trades, by the way, are not in round numbers. We see it. We consume all that data. So I like to look like a machine order. So I put in an order to buy 255 shares, something like that, right? So, and I put it in here, and then I'm going to put a stop, 1% below 50.71. And what's 2% from 50.71? Well, multiply 50.71 times 1.02, and there's my exit. And that's all I care about. And you say, well, that's not even outside the entry high. Yeah, well, I don't care. What do I care about what the price does? All I care is I want a 2% return on my capital. That's how you think about it. You have capital, you're committing it in a high probability pursuit for a known return. And that's what you're doing. Okay, I will stop there, and Brian, I'll hand it off to you.
Sounds good. Sounds good. Good to see everyone again. I was gone for a couple of weeks picking up my daughter from college. And then last week we got to celebrate with my son-in-law and my daughter. He graduated from law school. So it was a pretty momentous occasion, just a real fun family celebration. So wanted to cover a couple of items. One of them will be a repeat. I've covered this topic before, but whenever we kind of get to this part of the market, it's important, I think, to circle back. And what I'm circling back to, and I can cover this pretty quick, is when sentiment gets to the red line. So I wrote about this morning. I call it stretched conditions. The market is just getting a little bit stretched. And the question is, over time, what happens to the market when sentiment does reach these conditions? You can see over the course of the last year, we've had, what is that, four, maybe 5 times where we have been in similar conditions. So what I've done over time is I've just gone through an exercise, and I won't go through all of this, but I have data points going back to 2020. When we go above 6, how long do we stay there? And what's the return during that time period? So as we look back it's a little over 4 years, it's 70 basis points. It's approximately 2 weeks, 9.9 days. The return above the red line, once again, is 70 basis points. If you look at what happens afterwards, in other words, when it retreats back below the red line, what's the return? That's 40 basis points. So you get kind of stretched. The market's not returning as much as it once did, but it usually does not mean that the market just falls apart. Now, there are time periods where it does fall apart. So part of it depends on, where you are in terms of a market cycle. Look at 2022, middle of a bear market. We had some, let's call it bear market rallies. We moved above that 6 sentiment, above that red line. Look at these returns. They were terrible. 8.9% for one of them. Just absolutely atrocious. And that differs then when you have a bull market. You look at 2023. You see a lot of green during 2023, and that has continued for the most part into 2024. Here's that average for all of 2022, very different declines of 70 basis points versus average of 70 basis points higher. And then that bull market last year, average returns of 1.5%. So once again, the market becomes stretched. Part of it depends on what type of market we're in. I would argue that we're in a bull market right now. Could that change? Of course it could. But that's where we're at right now. And I just wanted to briefly cover, that sentiment above the red line and what that means. I also wanted to touch, and this, Tim covered this very nicely already. And actually, I love getting on these calls because I learned something from Tim today as well in terms of those, in terms of those prices. That's something good that I will incorporate going forward as well. What I do a lot during the morning, and I picked this up from Tim a couple of weeks ago, I've been entering a lot of pre-market orders as well. And I just wanted to give you an example. Let's look at Toast as an example. So entry low 27.29, entry high 27.99. What type of limit will I set for that? Part of it is going to depend on BCD, broad market sentiment, context, divergence, what's happening from a broad market perspective. If we're still, pretty good in terms of our overall setup, well, I'm going to be slanted a little bit higher. If I see the market is higher pre-open, I'm going to be slanted a little higher. The reason for that is if I enter an order, at 27.29, but pre-market is pointing higher, we have good divergence in the broad market, I'm probably never going to get that order filled. So you have to, choose somewhere in between. As Tim mentioned, that's exactly what I do. I choose odd prices. I got a little bit too cute this morning, to be honest with you. I had an order out there, but I set it a little too close to the entry low. It got close to being filled, but it never did. So if I was thinking through this, and if I would reevaluate today's, maybe I would go 27.44, something like that. And a lot of times what you'll see early in the morning, this happened to me a couple of times this week. You can see that early activity. Sometimes you'll get those quick moves down, and you'll get filled on some of those orders, sometimes within the first couple of minutes. And this doesn't always happen, but it happened to me a couple of times this week where one of them was in Dell. I had a pre-market order out there. I got back from walking the dogs. I had been filled in Dell, and I think the other one was VRT, and I already had my 2% gains in both of them. It's it's obviously not going to happen all the time, but when it does, you're like just grateful and like, oh, thank you very much. It's exactly the way that you want to approach things. One other quick time. Let me see if I covered everything there. In terms of what I'll look at pre-market when I'm looking at all these different names, I'm going to weed out ones that have had really large moves. Let's look at SMCI as an example. Look at yesterday's move higher. That's such an extraordinary move higher. There's a good chance that it's not going to behave in a normal manner the next day. And if I see those types of moves, I'm not even going to touch it. I don't know what that's going to do. It could continue to roar higher, but to me that becomes a little bit more of a gamble rather than something that I can consistently predict, if that makes sense. And of course, I'm also weeding out names that have earnings either occurring in the next day or two, or a lot of times I'll wait a couple of days after earnings as well, because you can get unpredictable trading around that as well. So that's how I'm approaching daily trading ideas, very similar to Tim, but I did appreciate Tim's thoughts in terms of picking up some of those stocks that have lower entry points. So I'm going to start incorporating that as well. I did want to circle back to broad market sentiment. We're up at 6. This is a portfolio. I named it the Barry portfolio. You're welcome, Barry. But I have a different short portfolio. But I do like Barry's short portfolio. I'll show you what the parameters look like for this one in case you want to set something up in a similar manner. So this is what it looks like. It's capturing sentiment that is starting to decline below 9. Market structure sentiment is moving lower. It has some of the other normal characteristics that you would see for the momentum portfolio, volatility greater than 3. In this case, instead of short volumes being low, you're looking at short volumes being high. And, Barry's had tremendous success with this. And just like with anything else, for those of you that are on these calls or make contributions, we like to point out the successes and thank you for them. So thank you for that, Barry. I wanted to point out that we're starting to see an increase in names there. Kind of makes sense. Market sentiment has really been in rally mode. If you do like to go short the market, I don't think we're there quite yet, but we might be getting there here, shortly. If you don't like to short individual names, here's a couple of considerations. SPXU, SQQQ, or if you like to get into volatility trades, I will sometimes trade UVXY. So those are 3 considerations, either for going short or for playing additional volatility in the market itself. So that was kind of the things I wanted to cover. Sentiment above the red line, those daily trading ideas, kind of tag teaming with Tim there, and those short considerations. Any questions, Tim, that I missed?
No, I don't think so.
Okay.
But I'm reminded of, I can't, Pam, was it you? I can't remember who asked. This was also last time. What do we trade short for NASDAQ? If SPXU is S&P 500, SQQQ is a great example. Very, very liquid security. And it's interesting, that SPXU spends a lot of time on the fail to deliver list, meaning there isn't enough supply, but if you're trading it intraday, you won't be the one stuck with it. It will be someone else. Probably Goldman Sachs. Citadel will make sure they hang that on a full service broker dealer somewhere near the end. Pam, thank you. Yep. Okay.
And if you're okay, Tim, I'll go ahead and cover like what I see in terms of the path ahead, and you
Please
can
do.
you can
Yep.
you can jump in.
Okay.
All right. So as I'm looking ahead, of course, broad market sentiment has hit 6, very low short volumes. We're in a state of divergence right now, which is fantastic. That's why we wrote this morning about this is generally a period that supports higher prices. The question is, where do we go from here? We are at a potential inflection point as we start to make our way through expirations. And take a look at short volumes in particular. Note how low they are, and note how many times that's occurred during the course of the last year. maybe 2-3 times, back here in December, maybe going back to July and then June. So what would we say going forward? What's the least likely path going forward? Well, we're just gonna have to let the data speak to us. If we look back at what happened during June, this is a good example to start with. We had sentiment that was well north of the red line, but sentiment stayed strong, right? Sentiment stayed strong, short volume stayed low, the market continued to rally. If we look at some of these other periods where we've been above that red line, here's a good example. We briefly got there. Demand quickly fell. Short volumes were high. What did the market do? Well, the market fell. We look back at this period, sentiment high, short volumes high. What did we do? Kind of floundered for a little while. And look back at when the rally started, really strong sentiment, low short volumes, and we started into that rally mode. So we can't really predict what's ahead right now because we don't know what's going to happen to sentiment coming out of expirations, but we'll be watching. Do we see something like we had back in the summer, or do we see something like we had back in the fall? And we'll just, we'll let the data speak to us in terms of what we see as we look ahead. But we do know that we are at a potential inflection point. And, why we call it an inflection point is because strategies can change. Maybe some of the derivatives contracts have become too expensive and market participants can't use the same type of leverage that they have been using. Maybe they don't have a choice. They have to get out of some of those leverage contracts. Or maybe as they look ahead to June, they see this rally, this tremendous rally that the market has had. And, maybe we have a few participants that are like, I don't know. The rally's been so strong. Maybe I employ some hedges instead of employing as much leverage as I've had. So I think let me see if there's anything else. That's really the thoughts that I had. We're just going to have to be data dependent, which is not a bad thing.
Yeah, I would add that if broad sentiment jumps back up to 6.5 or 7, then we're probably fine, because that is a hallmark of markets that may pull back a little bit at the top, but not roll over. If we don't, I don't like it. And John, I can see you're shaking your head. You know these data pretty well. What's your thought?
Oh no, I agree with you in terms of it'll be interesting today. Like the next 2 days is all being supported by the options. So once we unpin tomorrow, that'll be really interesting. The weird one we have is we have VIX that's on Wednesday, so I think there's a little bit there too.
Right.
Once we're past that, though, it'll be interesting to see. But this has been a pretty strong move up. So with demand where it is, like we're really stretched, and I think we might get a little bit of a pullback. But I don't think why would we roll over at this point? Nothing is telling us to that point. So I think that's what Brian was saying was great. I also think that's something else that we could do at broad sentiment in the future to help with the longer term trading. I love how he shows the percentage return based upon where we're at.
Mm-hmm.
1 week, 1 month, 3 months. I think would be helpful to look at that, because I think you guys do a good job of talking about it. But if we quantify it, I think it gives people more of a framework. So that could be like incorporated a BCD in the morning, maybe.
Yeah, you're absolutely right.
We're happy to help with you if you want to figure that out.
And John has done some really good data work on this stuff that's substantially evolved beyond what we have, and we don't overlook it. It's step by step to me. I'm just it took a while to me to get to the point where I feel like we have a pretty good set and forget capability. Now we need to refine some of those risk management strategies, and you're absolutely right about that.
I think what you have too, and I'm seeing it now, I'm learning from you guys as well, is that, I think coming out of that move, like from what I've seen, when you see broad sentiment make that dip down, it doesn't happen often. And it's really a strong signal that's telling you more than likely you're going to get a run up and you should actually be in the market and be aggressive, right? So like to me, it's, you don't want to time the market, it's time in the market, and you take as many of these opportunities as you can, because obviously the data is telling you should be in the market too, right?
Yep. No question. I agree with you. Yeah. And then if we can, on the flip side of that, avoid the pullbacks, you can capture the moves and avoid the pullbacks. There's the difference. That is the difference maker. And it takes both of them. Yep. Good note to end on. We've kept you a good while. So, thank you very much. We always appreciate the collaboration and the thoughts from all of you, because you do good stuff with data. I'm not very bright. I generally learn by doing it the wrong way first. Thanks, guys. Okay, we'll look forward to seeing you again next week. And that should be interesting, right? We'll be through everything that John just mentioned. We'll be through tomorrow's, your general monthly options expirations, what we used to call triple witching. Monday, new options trade. Tuesday, banks are going to square books. Wednesday's VIX expirations. And, sell and volatility is a pretty crowded trade. So it's going to be very interesting to see what happens. Thursday will be reality. So we'll see. All right. Good to see everybody. Thank you.